What does it mean, a private equity? What are you currently working on? Can you share with us, one of the acquisitions or investments? If you had to start all over again today, what would you do? The very first episode of the Capital Truths, and we're going to be talking about the untold secrets of those who are funding the future. And I'm super duper excited, guys, because for our very first episode, we have a Scott Hoffman. Well, Scott, not only he is one of the Black Card coaches, he is also an interesting guy. He is really smart when it comes to marketing. And every time I get on the calls with him, I'm like, OMG. He thinks outside the box and he really brings a fresh air to the marketing world. Besides that, he's also running Burgeon Capital. It is a fund which invests into businesses and really makes them profitable. So Scott, thank you so much, for being here, with us and the viewers on this podcast. I know you two are really, really busy, and I'm grateful for you to be here with the viewers.
No problem. I'm honored to be the first guest.
Thank you. So first question I have for you, Scott, for those who haven't met you yet, what would you say about yourself? How do you introduce yourself, let's say at a dinner party?
I'm the founding sponsor of a private equity fund. I have an MBA. My undergrad was in computer science. I spent 20 years as a senior sales guy, VP of sales, director of sales in corporate America. My last corporate job, I had a thesis and then based on that thesis, built the outside sales force for web.com. When I left web, I moved over to the marketing side and I was there for about 9 years. So I'm a bit of a unicorn because I understand both sides, sales and marketing, really, really well. For a period of time, I did wholesale real estate for about 1.5 years. And then starting about three and a half years ago, bought my first 2 companies with groups of investors, people that I knew in some way. Kind of like syndications or single asset funds. Okay. And then we founded Burgeon 18 months ago.
Sweet. And so the name Burgeon, how did you select that name?
So Burgeon, if you think of a burgeoning economy, it's a rapidly expanding economy. And that was really the word I wanted to latch onto, was because we're an open-ended fund, because we can raise and acquire businesses as we see fit. I saw us as a fund that could rapidly expand as we chose to. And that's really where the name came from.
I see. I love it. And so when you said, for those viewers which are not too familiar with different type of funds, what does it mean, a private equity fund?
Yeah, so there's really fundamentally only 2 types of investment funds in terms of private funds. There are hedge funds, which in some way deal with public securities. So that could be stocks, bonds, crypto, Forex. Those are all hedge funds. And then there are private equity funds, which will typically in some way interact with tangible assets. That might be a debt fund, that might be a real estate fund, that might be a fund that invests in super rare baseball cards. But private equity fund managers, we all invest in some type of hard asset or something that is in some way securitized by a hard asset. And that's really the big distinction. In our case, we buy companies using seller financing primarily. Where we provide a significant cash down payment and then the seller finances the rest of their sale price over a period of time. So as a fund manager, I have 2 primary jobs, and that's to find the companies that we acquire and develop our operators to run them and to raise money for down payments.
I see. And so I love that stuff, and we're probably going to go into it a little bit later, so stick with us. When you mentioned open-ended fund, what does that mean?
So there's 2 types of funds. The first one is close-ended. You'll tend to see that a lot in real estate, where they have a purpose that has a term to it. It might be typically in real estate, it'll be 5 years, 7 years, 10 years, could be longer, where the fund raises the money it needs to do whatever. Let's say it's going to build an apartment complex, or apartment complexes. It raises the money it needs to do its project, and then that money is apportioned out of the fund as the development life cycle happens. And then the investors are all rewarded at the end of that term, and their money is released. An open-ended fund is a little bit different because my one fund would be a similar example that most people would be familiar with would be Berkshire Hathaway, where they can continue to raise capital and acquire companies as they see fit over a period of time. That does not mean that the investor money can flow in and out like it could out of a stock investing account. All funds have something called a lockdown period, where that initial investment is locked into the fund for a period of time. And after that period of time, the investor does have the option to call their capital out. But the biggest difference between open and closed is that a closed fund has determined its lifespan in advance. So at 10 years, that fund will, although there may be a rollover period that the fund manager has, let's say the economy's being weird and it's not a good time to exit that apartment complex, then they can roll over the fund for additional years. But with those types of exceptions, the fund has decided that in 10 years it will cease to exist. Whereas it is an open-ended fund, we can continue to exist in any form that we think is best for the fund and the investors over time.
Okay. Well, it sounds like that the open-ended fund, it gives the investors a lot more flexibility, right? It sounds like it's more, you can pull the money out at any time. So why would someone even choose a closed-ended fund if you can do open-ended fund and just, have the flexibility at the same time? Yeah,
I mean, if an investor wants ultimate flexibility, they're probably going to find more of it on the hedge fund side. They tend to have shorter lockdown periods, as little as 3 months. In my case, the lockdown period on Burgeon Fund is 60 months or 5 years. So it's the investors can't free flow their capital the way they could out of like a stock trading account where you can just sell your positions or buy new positions. There's always going to be some term where you're locked down. The key to the lockdown is that it makes sense to the investor and to the fund manager why that capital would be locked down. It's very difficult. For example, in my case, I can't buy a company if I have investor money free flowing in and out of the account. It would make it almost impossible for us to forecast what companies we had the ability to buy at any given time. Mm-hmm. And so that lockdown period is intentional and standard. I don't know that I've ever seen either type of fund that has no lockdown period for investors. The shortest I've seen, like I said, is hedge funds, where some of them will have much shorter periods where because of the whatever their thesis is, whatever the fund was founded on, they may be entering and exiting positions at a pace that allows investor capital to move in and out.
Wow. Okay. So that's good to know. I have a question. What is something about you which doesn't show on your LinkedIn profile?
I think what most people say after they've spent time with me, and you've certainly been in a lot of my office hours calls, I see the world differently. I see the world as a marketer. And that's the way I dissect opportunities. And that vision, that ability to see the world differently, I think is probably one of my best assets as a fund manager, and has been across my career. The ability to take an elephant and break it down to individual bites, because that's the only way you can actually eat an elephant. So even when something like the transactions that we do look very complex from the outside, my ability to look at them and break them down into really small, easy to understand pieces is good for my team. It's good for the employees and contractors that work at our companies. And it's really good for our investors, because I can take something that on the surface looks complex, like the ability to acquire a company, or even to do due diligence on a company, and simplify it in a way where hopefully everybody around me can understand. So that's probably kind of my superpower.
I love that. And no, I can attest to it. That's 100% truth. And that's really, something I love about you so much, because you simplify things which, where they can seem to be super complex, but like you said, you really break it down into those little bites and pieces where it's implementable, by pretty much anyone. Now, Scott, what it means for you to be a marketer?
I think that being a marketer understands that whether it's transactional or has a longer lifespan to it, everything swirling around us, it has marketing and sales to it. Everybody is born a salesperson. If you're an infant and you don't like the way things are going, you will let the world know until things are more to your liking. You will kick and scream and cry. That ability to, and I'm going to use this word, but I don't mean it in a bad way, but that ability to manipulate your environment is the fundamental piece, building block of all sales and marketing. And so seeing the world as a marketer just means that you start to realize things like who the perfect customer is for a brand. And you can tell that based on where they're advertising, what their messaging is, what their colors are, the music they choose. Everything gives you clues to who their perfect customer is. And if you're really turned off by a marketing message, it's either because you are their perfect customer and they completely missed, or more likely you're not their perfect customer and so you weren't really supposed to be into that commercial in the first place.
Mm-hmm. I love it. Now, if your journey would have a tagline, what it would be?
Somebody years ago said to me, was describing me, who had worked with me for many years, and they were introducing me on a stage, and they said, all of us go through life and we're presented with opportunities, and most of us will start thinking why we shouldn't step into that opportunity. Scott doesn't have that check valve. So he's always thinking, how can I step into this opportunity? Not why shouldn't I?
Yeah. And again, I think it's your brilliant mind. It's not really thinking about the problems, but the solutions all the time. And that's...
I think that I work from the end zone backwards. If I'm going to stay with a football analogy, a game-winning drive, or even just a drive to score points, breaks down into several plays, but within those plays, there are also 22 humans on the field that all have to execute flawlessly. If I know that the end zone is to score points, then I can work backwards. And I think most sports coaches do this. I think great business minds do this. I think really good fund managers do this because they start with the end zone in mind, which is their thesis. And then they execute based on their belief in that end zone and the series of steps it's going to take to get to that end zone. And that doesn't just include investor returns. That's really important, but it's also about being true to yourself, maintaining your level of integrity, your level of communication, as you go through that journey of all of those elephant bites.
So were you always like that, or did you evolve into it over time?
No, I think when it really started to hit me was I had done a lot of different things in my young life. I had been a paramedic, I'd been a reserve police officer, I'd done safety for stunts and special effects. I'd done a lot of different things. And when I distilled that skill set of everything that I had done down to why I was really good at all of it, it was two things. It was my ability to not just hear what people said to me, but also how they said it. And so that was number one. And number two was my ability to use analogies and stories to help take something that sounded complex and make it really simple. And so I got my first organized sales job. I was selling copy machines in a physical territory north of Portland, Oregon. And my feeling with no experience was that if I only focused on selling a machine as my measure of success, I was going to be pretty miserable because the best person in the office was probably selling 6 machines a year. And so I was going to have to figure out a different measuring stick. And so I took the sales process and I broke it down into little steps, again, little elephant bites. And so that would be things like if the person at the front desk gave me the name of the person that was in charge of making decisions about the copy machine, that was a big win. If they let me take a look at the copy machine and I could look in the recycle bin and see the types of copying jobs they were doing, that was a big win. I could look at the counter on the machine and see how old their existing machine was. Those were all wins. And then what I did was I had a cooler in my car and I had like those little Snickers and Milky Way and Three Musketeers and Hershey's like 1-bite candy bars. And whenever I hit one of those wins, I would not continue to prospect, but I would actually stop and go to my car. And as slow as I possibly could, I would eat one of those candy bars. And it was my way of having the dopamine release of the win. And by focusing on micro wins, then I had wins every day. Very quickly became a top seller. 4 months after that, they gave me my first sales team, which is a whole different world because now you're trying to help a bunch of people with very different skill sets to be successful. Managing a sales team is not like managing the accounting department. It's more like cat herding. But I continued that process of always taking the task in front of me and breaking it down into its smallest possible elements and finding ways to create what I called micro wins or micro victories along the way. And I think that's continued to serve me well all the way up to what I'm doing now, both as a coach, as a fund operator. I have the 2 businesses outside the fund right now that I operate. So there's a lot going on, but it all fundamentally comes off of micro wins.
That is awesome. And I love that you mentioned that because I think a lot of us entrepreneurs, high performers, we tend to beat ourselves down all the time. because we feel like we are never enough, and there's always the next level, right?
Yeah.
But those little rewards and patting on the back, those are the things which actually fuels the tank for you to keep going, right? And to keep on striving. So I love that analogy. I'm trying to stay away from sugar, so I might give myself some berries or raspberries and maybe some
Sugar-free something,
maybe some black chocolate or something, because I think we all addicted to sugar these days. But let's switch a little.
Yeah.
I would like to know, like, what are you currently working on? I know you said you got a couple of businesses, outside of fund a little bit. Tell us more about that.
So my first two businesses I bought with investors without a fund structure, more similar to syndications or single asset funds. We're in the process, and it's not simple, but we're in the process of doing a stock swap where we're going to acquire a business in the fund, and then we will stock swap a portion of the equity in that business for the equity that those investors own in the two other businesses. And those investors aren't 100% in common. And they'll be rewarded with some multiple of the current value of the company. Then we'll absorb it into the fund. And then one of my operators will operate the combined entity, taking it forward. It certainly simplifies my life because now it's inside the fund structure. But there's also value because with the way that my fund is built, the more operating expenses I can keep inside the fund, the better for the investor. So the more standard business expenses that we don't pay to outside vendors, but we pay to companies that we own inside the fund, the higher the returns to the investors are. So in this case, these two businesses are both marketing businesses. So it's an easy decision to bring them inside the fund because then they will serve every other company that we acquire. Beyond that, I'm a pretty heavily involved coach with Fund Launch. I enjoy working with Bridger and Mason. I enjoy working with the Black Cards, and really just kind of being a disciple or an advocate for the things that I have watched be true for 30 years. For instance, it's very rarely the best product in the market that gets the business. It's 100% the product that has the best marketing. And that's been time tested across every vertical and every niche. It includes investment funds, that the best marketing wins. And so my mission has really become to take fund managers that are extraordinarily intelligent and incredibly talented, but maybe don't have a lot of sales and marketing chops in their background, and to help them understand what great marketing looks like by having them start to dissect the world around them. So we've talked about Super Bowl commercials, and we've talked about fast food commercials, and we talked about name brand versus generic allergy medicine at the drugstore. Because the more aware you become of all of this swirling around you, and then have the tools to dissect it, then you really start to embed in your own mission the importance of understanding who your perfect investor is, the messaging that will resonate with them, and where you can find them based on who they are. And all of those things are going to reduce the amount of money that it takes you to acquire another investor.
I love it. And so, those businesses, I know you said you don't invest into foods businesses, I believe. And I'm really curious why not? Because that is something, we all need to have. That's necessity. And second, what type of businesses, actually invest into? What is your buy box, and how did you actually determine the buy box?
Yeah, so I don't have an aversion to food. I like to eat, but
Sweets, right? Snickers and Three Musketeers, you said?
Yeah, less of that now. I was a much younger man when that was all happening. The good news is I managed to get through that period and still have no cavities. I think that the people that are in the food business, whether that's the customer facing like restaurant business or the producers and co-packers behind them, they're really good at it, and they have an expertise that I simply don't have. And when you're dealing with an industry where the margins are pretty narrow to begin with, it wouldn't take much of a misstep to get sideways very quickly. So I can appreciate the companies like Darden and the other big food companies that are out there. It's not a space that I have the expertise to dabble in. And I don't think you can just acquire a food company here and a food company there. I think you kind of have to be all in on that space. And even just to be able to develop your leaders. Really the only other industry that I won't look at, and it has nothing to do with the industry, is CBD. I don't have any aversion to the industry. The problem is that as it stands right now with federal law, I can't walk into a normal bank and transact business with those businesses. And that's problematic for me as a private equity fund manager. And so those are really the only two businesses we won't look at. Our buy box really starts at the top with gross sales between 1.2 million and 10 million. And we're really hunting it's almost interchangeable at that size business, whether they call it net profit or seller discretionary earnings or EBITDA. But we're really looking for 25% plus because we have to service the debt and we also need to grow the business. And really, the reason that we determined that buy box is we didn't want to buy companies where we were buying a job. That would be a plumbing company that has one van and the owner's in the driver's seat, which means to buy out the owner, I have to climb in that driver's seat. And I'm not a plumber. Mm-hmm. So that's problematic at the low end. At the top end, we wanted to stay out from under much, much bigger private equity because their competition with each other drives the multiples up that they pay for companies. And so we wanted to stay in the space where we're largely by ourselves. It's very rare that I'm talking to a seller or their broker and there's any active competition in the deal. A lot of that is because the largest number of baby boomers started turning 70 a couple years ago. And the original retirement plan was the kids will come in and take over the business. That hasn't worked out the way they thought. The kids don't want the business. And in many cases, their entire retirement is wrapped up in that business. And so it makes them, I think, more amenable to seller finance. Mm-hmm. It certainly makes the conversation simpler for me because I can give them their price and get my terms, and everybody's going to win in the long run.
I love it. So I wanted to ask you, like, why would someone sell a profitable business, right? Why they wouldn't keep on running it? And you said it's the baby boomers, which they're about to retire, and they want to kind of enjoy the money too, right? Like, how much time we really have on this planet Earth. But what percentage would you say for business owners, which are actually the kids they can take over, or they have to sell it to a private equity fund, or maybe just shut down the doors, because what is they going to do?
Right. The two choices are find somebody like me, because there aren't a lot of buyers in the spaces that we're in that are writing a check and just paying cash for a company. That's a bit of a fantasy. And I think the business brokers perpetuate that fantasy a little bit to get those business listings. But I think it becomes apparent to the sellers fairly early that it's awful quiet. That people aren't lining up to jump all over their company. The alternative to me is that they shut it down. And since most businesses in this size are not asset heavy, you're talking about old dated office furniture or old shop equipment, stuff that if they liquidate it, it's going to be a garage sale. It's not going to be an auction at Sotheby's. And so I represent an alternative that gives them the ability, and to ask your first question, the reason that they sell businesses will come down to a handful of reasons. If they're younger, it's because they're burnout. They've spent 5, 6, 8, 10 years building a company, and they're just exhausted and they're ready for something different. So that could be number one. Number two could be something more emergent, like either their own health starts to fail, or they have a major health event, or a spouse has a major health event, something that's going to kind of push their timeline up quite a bit. And then the last reason is exactly what you said, like to be old enough to have earned the value that the business is being sold at, but young enough to still enjoy the proceeds of the sale. I'm not 70, but I would imagine when I turn 70, my bucket list will come into focus pretty sharp based on life expectancy. I think in a lot of cases, the spouse of the founder is probably pushing them and saying, like, you promised me, a trip to Spain or whatever it is, that has been pushed off for years. And now that drumbeat has gotten loud enough. The kids are out of the house. They're well into grandbabies, and they want to be able to enjoy the proceeds, and also control the disposition of those proceeds, whether that's into a multifamily family office type scenario, or a trust, or whatever their investment strategy is for the proceeds of the business. So those are the motivators that I see, even though the business is profitable, because something has put them in a position where they believe continuing to run the business is simply not worth the profit. And we're not talking about small profit numbers. We're talking about, in many cases, mid to upper 6-figure or 7-figure net profit. But I think you just get to a point where other things start to become more important. You've paid everything off. There's only so much stuff you can acquire, and there's other things you want to do with your life.
Yeah, and I mean, look, you can always, make more money, but you don't necessarily get more time sometimes, right? So I love that. Can you share with us, one of the acquisitions or investment into one of the businesses? How did it look like? What the process was? Can you maybe share some of the insights? What did it look like for
the business? The first two legs are always that it's profitable and that it has some tenure. We don't invest in startups. We're not a VC. And we don't do turnarounds, which is a whole specialization for people that will take on troubled company, which is like VC, but at the other end of the success scale. So those are our first two legs. So when we're looking at a business, first of all, I just have to like the industry. I think AI has added a wrinkle into our initial due diligence because we're kind of looking at businesses and whole niches now and kind of considering, the impact that AI might have on that business. I think white collar businesses will be impacted by AI much greater and already are in some niches at a much more accelerated pace than blue collar. AI is still not going to be able to dig a ditch or figure out where a plumbing clog is. Things like that where AI might help, but you're still going to need a human. Having said that, I love white collar businesses. They're more profitable by their nature.
And when you say white collar, just for the viewers, like what type of jobs, white collar, blue collar, so they can.
Yeah, so white collar is going to be accounting firms, law firms, medical businesses. Those type of businesses are white collar. Blue collar tend to be hands-on. They'll have a labor component that's typically more expensive. In many cases, they'll also have an inventory component. So if you own a plumbing business, you have your people, and then you have your parts and pieces. Same thing with auto repair. The white collar versus blue collar is an old description. White collar tended to be college degreed, and in theory didn't get their hands particularly dirty. Blue collar was because the shop shirts and factory shirts that people wore tended to be blue, and that's really where blue collar versus white collar came from.
And I love it. I think, I remember me growing up, it was like, you got to do the white collar job, right? The blue collar was kind of looked up front upon. And you're right, they were not making as much money. But I feel like, especially within our space, sometimes the contractors, they make more than the lawyers, right? Like,
yeah, well, they do. And I think we had a whole generation of parents that were blue collar parents that didn't want their kids to be blue collar kids. And so they sent them to college. We can have lots of conversations about that, whether that was right or wrong. What it means today is that blue collar businesses are highly profitable because it's harder and harder to find good people to service the customers. And that has driven the price up. So the price to get an electrician or plumber to your house now compared to even 3 years ago or 5 years ago is triple. And it's still climbing. And that's because there aren't enough people entering those professions, despite the fact that they can be six-figure earners. So first and foremost, I have to like the industry. And I'm kind of looking at the landscape. Who are the big players? A lot of these industries, there'll be giants and then there'll be everybody else. That'll be really, really small. And the opportunity for us initially is in that gap in between, whether that's because we buy several businesses of the same type and stitch them together, which is called a roll-up, or maybe they continue to run independently. So the first thing is, do I like the industry? And I'll give you a real world example. I had been staring at the insulation industry, the spray foam insulation industry specifically, for quite a while, had done a lot of research on it. Really like the industry, zero impact from AI anytime soon. And honestly, a lot of people running the businesses that were more technician than operator, and that creates an opportunity for us. So we started looking at opportunities across the country. In the process of looking at an opportunity on the West Coast, it backed us into a dealership because we typically won't buy franchises, but a dealership model is a little bit different. Cars are all dealerships. John Deere is a dealership. Tractor and bulldozer businesses. Caterpillar is a dealership. And we're not as allergic to that model as we might be franchises. Long story short, the dealer had built a company store, essentially a company operation in Pittsburgh, Pennsylvania, that they weren't particularly good at running. They were really good at being a supplier, being a supplier to their dealers, not so much boots on the ground running the day-to-day operations of a company. So, and yet the company was profitable. So it was almost like they were stumbling and bumbling into profitability. So we acquired that business in February this year. We're on track right now to double it, both in gross and in net profit by the end of the year, just by being active as owners.
And double it from where they were to where they're going to be now.
Correct.
Incredible.
So when we bought it, it was doing 1.4 with 40% margins. We'll almost double gross. We'll be up over 2 million. And our profitability will be above 40%. Gross profitability, that's before debt service and the money going back to the investors. But I have an operator there, boots on the ground all day as a general manager. He's empowered to run that business. I have a very simple management mindset and edict to all of my employees, but especially the operators and managers. Rule number 1 is be a good human. Rule number 2 is do amazing shit for the customer. And rule number 3 is forgiveness over permission. I would rather have people doing amazing stuff for the customer and then coming and explaining what they did later than freezing up and waiting for approval from me or anybody else to do the right thing for a customer. And so when we take over a company, we really start trying to infect the business with those cultural beliefs. That means we tend to pay better, noticeably better than our competitors, but we also expect more from our people. That creates job security for them, but it also creates an expectation of quality for us as a brand, and the stability of the fact that our employees continue to be around consistently. And the things that people don't think about when they're thinking about just buying a business is, what are you going to do when one of your employees' pregnant wife is in labor, or they lose a family member, or life happens, and so what have you baked into the business to handle the fact that you're acknowledging that life will always happen, and yet you still want to have, as best you can, continuity of business going forward. So I have to like the industry. Then it's math. As I said earlier, these businesses are not asset heavy, so the balance sheets are almost worthless. We really zero in on the P&L, and then our due diligence goes beyond. We're looking for confirmation of the P&L from bank statements and credit card statements. Most small businesses of this size are not particularly complex to analyze. They don't have high volumes of transactions. The transactions they do have are fairly predictable. That makes them easy from an analysis standpoint to kind of tear apart. So in the case of Spray Foam, we like the business, we like the P&L. We could tell that there was a lot of room for net profit growth, even without business growth, because of the way it was being run from a distance. And that was really the opportunity. So we started talking about that business in June or July of 2024, and we took over the business in middle February of 2025. And some of that timing was letting the business get through the holidays, and then also picking a date that just worked for everybody when the transition would make the most sense. Since that time, the whole business, all the SOPs now are developed for that business. The business is running really smooth. We've shuffled some people around into different roles where they're much more successful and I think much happier. I make the first 100 days, I'll make 3 trips. Wherever we buy a company, I'll make 3 trips to the company. If it has a physical location, a 30-day, 60-day, and a 100-day drop-in. And it's really just because my job was to develop the vision for where I wanted to see that business headed. And then it's really the operator's job to execute on that vision. And so I'm just kind of milestone measuring, how are we doing in that march? Are we running into unforeseen barriers, if any? And what do we need to do to overcome those? Are we as efficient as we can be? Are we as safe as we can be? And are we doing amazing stuff for the customers?
So I mean, that's awesome. And I mean, it sounds like really a no-brainer, not only for people looking to retire, but for people maybe looking to take their business to the next level too. So my question is, the owners, right? Are they gonna still sort of be in charge or some type of a control? Or are you really making the calls and they kind of taking a back seat? And 2, at what point, they're free to go and they can sort of just enjoy the profits from it?
It's a great answer. It's a great question. The answer is it depends. What doesn't depend is we will be 100% in charge of the business. At the same time, businesses develop what I call tribal knowledge over time. They learn ways to do things and ways not to do things. And not all of that learned information is good for the business, but they have accumulated it. And so the advantage to seller financing is I can keep that seller as close as I want them, but no closer than I need them. So there'll be an initial transition period where they know they're expected to be available to us full time. But after that, it's just, me having the ability to ask questions, bounce ideas. Hey, did you ever try this? Why didn't you try it? Or if you did try it, how did it work out? So we have their attention for as long as they're getting checks from us. And it also creates a certain amount of protection for the fund, because the reality is when you buy a company, I don't care how good your due diligence is, you will always have blind spots. There will always be things that you simply can't see. Sellers are very resistant to hand over their customer list, for example, and understandably so. It's a really sensitive piece of information, regardless of the NDA that you signed, regardless of the letter of intent you signed. And so there's going to be a blind spot there. And so buying the companies this way also gives us the protection to be able to say, wait, whoa, there's something here that was not apparent in due diligence, and we want to work with you to resolve it. And instead of paying you your regular payments, we're going to escrow those payments until this is resolved. That's the worst case reason to do seller finance, but there is some comfort food that comes out of it for the fund. So in some cases, however, a business can be sizable and still be heavily dependent on its founder, specifically on the relationships that the founder has with key customers. And so that handoff could be years, not months, where you're going to continue to have the seller on a salary, and other compensation, because that handoff is going to take an extended period of time, if ever. And you want that for business continuity. You don't want to lose your best customers because you suddenly told the seller that they could stay home. So it really depends on the business. With spray foam insulation, we have active communication with them, not daily, but a couple times a week over whatever issues, because we are a dealer. So we're interacting with them already. But I would say initially it took a good 50 days where we were chronically having Zoom calls and stuff with them. Some of that was the way that they had entangled the company store with their corporate operations. It made it really hard for us to peel things apart. So every company is going to be different. That's going to be part of the conversation. Sometimes the seller just wants to stay involved because they want to have this business has been what got them out of bed every morning. And they still want to have purpose. And so if I can have them have purpose, but at the same time have them acknowledge that they aren't running the company, then I'm all for having, another pair of eyes and hands involved in what we're doing. But as I said at the beginning of my answer, we are 100% in charge of the company, regardless of how the ownership is structured or anything else. We could own 5% of the business and have 100% control by the purchase agreement that we execute.
That makes total sense. It kind of reminds me of, selling real estate for many years. And when you have the seller actually trying to show the property and trying to like sell the customer why they should be buying their home, it just doesn't feel good in that situation, right?
Yep.
So, any last thoughts and can you share with us, what do you have coming up in the next 12 months that you are super duper excited about? Maybe it's not outside the box yet, but something you've been working on for a while.
Our goal for the rest of 2025 is to buy 2 more companies. We have companies under LOI, so we're heading into due diligence, and we'll see which of those land. My first rule for myself is don't overly fall in love with a business, because they can look really pretty on the outside, and then you get in and run them and realize that maybe there was a little bit of mirror on the wall going on there. So it really has to be a transaction, and that's what the investors expect from me. They want the operators that I put in place to love what they're doing. But in terms of the companies we buy, I need to stay transactional. Beyond buying the 2 companies, it's really just that we get those first year returns back out to the investors. I'm super excited for the trajectory we're on right now. I think we'll exceed our original waterfall, which is always a great feeling as a fund manager. And then beyond that, we bought a position in a sports marketing business that's heavily focused on the NIL space, payment for high school and college athletes. And so we're actually making some moves now to start to really gin that business up and take it forward from kind of the inception point where we got involved to where I think that business can be in 2 years. That's a lot of fun because you're around some really great humans. These athletes and their families are just super. And it's fun, just obviously because it's sports. And then beyond that, it's to continue my coaching with Fund Launch, to help more black cards like you think like marketers, and be out on a boat or on the beach here in Clearwater as often as I can be, I guess.
Yeah, not bad. It's definitely better than the Northeast, right?
Yeah, I'm allergic to winter, so I spend as little time in the cold as I possibly can. And not that it doesn't get chilly here, but it's a different kind of chilly. I mean, here in Clearwater, if the temperature drops below 65, we all start putting hoodies on.
Yeah. We got 46 today.
Yeah, you can have that. For whatever reason, the beach or Wendy and I going out on a boat with friends or by ourselves and kind of exploring. There's a lot of beaches on the Gulf side of Florida you can only get to with a boat. For whatever reason, that's super calming to me. It's I'm not unplugged. I still have tech with me, and I'm still fully functional. But for whatever reason, it just really, really slows me down. And I think as important as it is for me to be a great fund manager, part of that comes from my ability to create hard stops in my schedule where I step away and shut down, reset, try to not process business information, just kind of be super interested in the seashells that are in front of me, or the temperature of the water, or anything that just lets me spin down to zero and then come back up. So I have those hard stops built into my schedule now, where I'll take off on my e-bike and just head for a cove or a beach or someplace that's pretty quiet and just, kind of park my butt in the sand and shut it all down for a bit.
And I mean, that's so important to really have the ability to stop and recharge the battery so you can keep on going, right? And striving. Now, if you had to start all over again today, what would you do differently?
As goofy at times as my journey has been, I don't think I would do anything differently. I think I would have spent less time in my sales profession and maybe half time in marketing. I still would have wanted to have those two spaces. That would have got me in private equity earlier, but everything happens, exactly the way it's supposed to. My journey brought me to a place where I'm really good at what I do, and my investors and the black cards and everybody else that I interact with seems to really appreciate that I'm really good at what I do. So I don't think I would have done anything different. I might have just done it a little faster earlier on. But also I don't do regrets. So, like I said, as goofy as the journey's been, I'll take it exactly as it has come.
That's awesome. I love it. I know we run out of time. I want to be respectful of your time again. Scott, we really, really, really appreciate you. For you viewers, if you guys have any questions or comments, just drop it down in the comments below, and we're going to see you soon.
Yeah, happy to be here. Thanks for having me.
Thank you.
And that's a wrap on this episode of Capital Truths, the unscripted journeys of those who fund the future. If something sparked your thinking today, don't keep it to yourself. Share the episode, leave a comment, and keep the momentum going. Money is just a tool. Clarity is the game. Stay curious, stay bold, and we'll catch you on the next one. Peace out.